In today's video, we're diving deep into one of the most crucial topics for any investor: how to manage investment risk in a volatile market. Whether you're a seasoned pro or just starting on your investment journey, understanding how to protect your portfolio when times get tough is absolutely essential. With markets constantly moving, the possibility of big gains or significant losses is always looming. But here's the good news. With the right strategies, you can not only manage risk effectively, but also position yourself for long-term success. So let's break this down into 5 essential steps to help you safeguard your investments and stay on track for your financial goals. Let's kick things off by addressing the big question: what is market volatility? At its core, volatility refers to the rapid and often unpredictable swings in asset prices. And while volatility is a natural part of investing, it can cause a lot of anxiety, especially during times of economic uncertainty, like recessions or political instability. In the UK, for example, factors like interest rate changes from the Bank of England, currency fluctuations driven by geopolitical issues, and global economic trends all contribute to market volatility. As an investor, this means your portfolio could see sharp rises and sudden drops in value. But, and here's something important, volatility is not always a bad thing. In fact, it can create incredible opportunities, allowing you to buy into undervalued assets and potentially achieve higher returns over time. The key is understanding your own comfort level with risk, what we call your risk tolerance, and adjusting your investments accordingly. For instance, if you're someone who has a higher tolerance to risk, you might be comfortable investing in more volatile equities, also known as shares, with the expectation of greater potential rewards. But if you're a bit more conservative, you may prefer bonds or lower risk funds, which tend to offer more stability. And keep in mind, different types of assets respond differently to market volatility. Equities, for instance, can experience sharp swings, while bonds usually stay more stable. Another method for reducing volatility and smoothing investment returns is by way of making regular investments. We've explored this further here. Now let's talk about one of the golden rules of risk management. If you take away one thing from this video, let it be this: diversification is key. This involves spreading your investments across different asset classes, sectors, geographical regions, and even currencies. The goal is simple. By ensuring your portfolio isn't overly concentrated in any one area, you reduce the risk that a poor performing investment could drastically affect your overall wealth. So, what does a well-diversified portfolio actually look like? Well, it could include a balanced mix of global equities, government and corporate bonds, real estate, and commodities like gold or silver. What makes this so effective is that each of these asset classes behaves differently under various market conditions, especially during times of volatility. Equities, for example, are generally seen as a higher risk because their value can fluctuate quite dramatically in the short term. However, they offer substantial growth potential over the long haul. On the other hand, bonds, especially UK government bonds or gilts, are considered safer investments, offering fixed returns and greater stability. Real estate provides the dual benefits of potential capital growth and steady rental income. And of course, commodities like gold often act as a safe haven asset during market downturns, helping to preserve wealth when other investments may be losing value. Now, let's dig a little deeper into why diversification is particularly important in volatile markets. Let's imagine a scenario where the UK economy is struggling, maybe due to rising inflation or consumer confidence taking a hit. In such a situation, domestic equities might suffer. But if you've also invested in international markets or bonds, those assets may still perform well. For instance, US stocks or emerging markets could be experiencing different economic conditions, offering you some protection. Likewise, government bonds or assets like gold could rise in value as investors seek safer places to park their money. This balance across different asset classes is what makes diversification so valuable. It ensures that if one part of your portfolio is underperforming, another part might be holding steady or even thriving. And importantly, when markets recover, a diversified portfolio gives you the best chance to participate in that growth, whether through equities bouncing back bonds providing steady income, or commodities appreciating in value. In the UK, diversification can also come with some significant tax advantages. By holding a mix of assets in tax-efficient accounts, like ISAs or pensions, you can shield yourself from capital gains tax and benefit from tax relief on pension contributions. During volatile markets, when market gains might be harder to come by, protecting your returns through tax efficiency becomes even more crucial. In volatile markets, it's easy to think you can outsmart the system by timing the market, selling when prices drop and buying when they rise. But, and this is a big but, time in the market is far more important than timing the market. The longer you stay invested, the more likely you are to benefit from market recoveries and long-term growth. Consider a hypothetical UK investor, Sarah, who in March 2020 saw the COVID-19 pandemic cause markets to plunge. Panicked, she sold her investments at a loss, thinking she could buy back in when the market recovered. But the markets rebounded quicker than she expected, and by the time Sarah reinvested, she had missed out on a 20% market gain. If she had simply stayed invested through the downturn, she would have not only recovered her losses, but also gained more. By trying to time the market, Sarah ended up costing herself returns and triggering unnecessary capital gains tax on earlier profitable trades. The lesson? It's best to stay invested for the long haul. Next up, let's talk about the importance of rebalancing your portfolio, a crucial but often overlooked strategy for managing risk during market volatility. Over time, as certain assets in your portfolio perform better or worse, the balance between the different investments may shift. For example, if equities perform well, they might start to dominate your portfolio, leaving you exposed to more risk than you initially intended. Rebalancing is the process of restoring your portfolio to its original asset allocation, ensuring that your investments stay in line with your risk tolerance. So, how does this work? Well, it's simple. You sell some of the overperforming assets and reinvest those proceeds into the underperforming ones. This brings your portfolio back to your desired risk level, keeping things balanced and aligned with your financial goals. Let's say you're targeting a 60% equity and 40% bond portfolio. If equities have a great year and now make up 70% of your portfolio, you're taking on more risk than you initially planned for. By rebalancing, selling some of those equities and buying more bonds, you're reducing that risk and ensuring your portfolio remains diversified. A word of caution for UK investors: be mindful of the tax implications when rebalancing, particularly if you're selling investments held outside of tax-efficient wrappers like ISAs or pensions. If you sell investments that have appreciated in value and the gain exceeds your annual exempt amount, you could be liable for capital gains tax, which is taxed at either 10% or 20% depending on your income tax bracket. To avoid this, it's a good idea to carry out rebalancing within tax-efficient wrappers like a stocks and shares ISA or a SIP, a self-invested personal pension. These shelters help you protect gains from tax, making rebalancing a more tax-efficient strategy. Another effective approach during volatile markets is to use safe haven assets and hedging strategies to protect your portfolio. When markets are turbulent, many investors seek out assets that are less sensitive to market swings, assets like government bonds, gold, or even holding cash. These can provide a buffer of stability when the rest of your portfolio is exposed to riskier investments. For UK investors, gilts, UK government bonds, are a classic safe haven asset. They are considered low risk because they are backed by the UK government and they can provide steady returns when equity markets are in turmoil. Cash, while not a growth asset, offers liquidity, giving you the flexibility to take advantage of future opportunities without exposing yourself to further market volatility. For those looking for more advanced strategies, hedging is an option worth considering. Hedging involves using financial instruments like options or futures to offset potential losses in your portfolio. For example, if you're concerned about a specific stock in your portfolio losing value, you could purchase a put option, which gives you the right to sell that stock at a predetermined price. If the stock falls, you can exercise the option, effectively limiting your losses. It's important to note that while hedging can help manage risk, it comes with its own set of costs and risks. Not every investor will be suited to this approach, and in the UK, any gains from hedging strategies could be subject to capital gains tax. As always, you'll want to factor in the potential tax implications before adopting more complex investment strategies. So, to recap, managing investment risk in a volatile market boils down to adopting a few essential strategies. Diversify your portfolio, stay invested for the long term, regularly rebalance to keep risk in check, and consider using safe haven assets or hedging if appropriate for your circumstances. By following these steps, you'll be better positioned to ride out the highs and lows of the market with confidence. It's crucial to remember that volatility is a natural part of investing, and while it can be unsettling, it also creates opportunities. With the right strategies, you can mitigate the risks and take advantage of market recoveries when they occur. And of course, always ensure your investment strategy aligns with your personal financial goals and risk tolerance. Don't forget the power of tax-efficient wrappers like ISAs and pensions to help protect and grow your wealth, especially in times of uncertainty. We hope today's video has given you valuable insights on how to manage investment risk during volatile markets. If you found this information helpful, be sure to give us a thumbs up, subscribe to our channel, and hit that notification bell so you never miss any of our future content. If you have any questions or topics you'd like us to explore in upcoming videos, drop them in the comments below, or feel free to reach out to us directly via the link in the description. Also, make sure to check out the Xenia learning page, which we've linked in the description box. There, you'll find further reading materials, as well as a full transcript of today's video, so you can revisit any of the key points we've covered. Lastly, always seek professional financial advice that's tailored to your personal situation before making any investment decisions. Every financial journey is different, and a professional can help guide you in the right direction. Thanks for watching, and until next time, plan smart and prosper.